Welcome everyone to your first steps into multifamily investing. My name is Leah with Sense Financial. We are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. I briefly want to introduce one of our speakers today, Brad Sininsky. He is a solo 401k and SDRA consultant here at Sense Financial. He has a professional journey spanning over 18 years in real estate investing. Brad is also a licensed California real estate agent, and his passion lies in empowering people to attain financial independence. We'll be introducing Linda on the second part of this presentation, but thank you again, Linda and Brad, for joining us today, and I'll let you take it from here, Brad.
All right. Thank you, Leah. Really appreciate it. And yes, we are here to talk today about going from 2 suitcases to 397 units. And then the little subtitle is Plus Multifamily Investing Fundamentals. So we're going to talk about that. But before I introduce our very special guest, Linda from M2RE, which actually stands for, well, I'll let her share that story. And before I get into that, introducing her, I'm going to share a little bit about what we do at Sense Financial here. You already heard about me. I am a self-directed solo 401k IRA consultant here at Sense Financial. And this is just a quick disclaimer. This is informational only. We are not here to provide advice. If you need financial or legal or tax advice, please seek out the proper professional. This is informational only. And just about Sense Financial, we specialize in self-directed retirement accounts with what's called checkbook control, allowing you to bypass the custodian when you're making investments. We've been around for about almost 16 years now, and our clients have given us plenty of 5-star reviews on all the major websites. One you may not have heard of is Bigger Pockets, which I highly recommend you check out if you haven't already. It's like Facebook for real estate investors. It's very cool. It's been around since like 2008. It's well established, but hundreds of thousands of people on that website. Lots of good info. And then we have about 5,000 clients right now, and we've set up well over 6,000 different types of self-directed retirement plans for them. And most of our clients come from referral, which we feel is a testament to the level of service that we provide. And what we do is checkbook IRA and solo 401k primarily. Actually, that's it. And so we do it at a very high level. Our founder, Dmitry Fomachenko, when he started this company in 2010, he decided, you know what? I'm going to be very focused. I'm going to be very intentional. I'm going to say no to shiny objects because we could have added a lot of ancillary services over the years. And he has said, nope, we're just going to do what we do, and we're going to do it at a very high level. And because of that, I think we're able to provide a very kind of robust customer service experience for our clients. And real quick, the benefits of an IRA or 401k as far as being self-directed is allowing you to actually take control of what you want to invest in, which we feel provides true diversification, because not only does it open it up for pretty much anything you want, but it also opens it up for alternative assets. And alternative assets, actually, I'll share on the next slide what I mean by that. But the investment returns can be tax deferred in a traditional type of environment, or they can be Roth, after tax type investing, which essentially gives you tax-free ATM withdrawals down the road. You can get non-recourse financing if you want to invest in real estate with leverage. And we talked about checkbook control very briefly, but essentially our plan allows you as the plan owner to control the direction of the funds, as well as sign on the dotted line for investments and actually receive payments from the investments that go back into the account owned by the retirement account. And so you have this checkbook control aspect to it, which is a very efficient way to self-direct, especially when you talk about non-Wall Street alternative assets. And then the solo 401k, we call it the ultimate retirement plan. It really is a true tax shelter because you can contribute up to $77,500 a year if you're over 50, $70,000 if you're under 50 on an annual basis. And that could be Roth or traditional. It's all built into the same plan. So it's very robust. And I mentioned unlimited investment options, but some of the most common are real estate, both single family and commercial, precious metals, Bitcoin, or other cryptocurrency. You can actually do you can do private lending. That's one of the probably more preferred way of investing alternatively, is by actually having your retirement account become the bank and lending to individuals. Hopefully, they're secured loans, and we don't necessarily advocate unsecured lending, but when it's secured by something like real estate, it's a pretty safe bet because if there is even a default situation, you can foreclose on the property and the retirement account can be made whole. So that's kind of the worst case scenario when lending, when doing a loan secured by real estate. Tax deeds, trust deeds, pretty much the sky's the limit. You just have to be aware of certain disqualified parties and prohibited transactions that we're not going to get into today. But also, you cannot invest in collectibles or life insurance in an IRA. So those are the two requirements. In fact, the IRS doesn't tell you what you can invest in. They just tell you what you can't invest in. And I just mentioned those, what you cannot invest in. So true diversification. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. And you don't want to be like this couple here whose basket of eggs all fell out. Of course, some of them are still intact, but a lot of them are broken because they're all in one basket. The basket fell over and they all fell out. And so we believe that self-directing provides that true diversification. And one more note on that. When you're investing in something that you know and understand, real estate is just one example. It's a common investment vehicle that people choose because it's such a, it's a safe bet, right? And it continuously goes up, it seems like, for the most part. But nevertheless, when you invest, when you self-direct and you invest in what you know and understand, it doesn't necessarily have to be real estate. It tends to be a safer bet, if you will. The smart money is on what you know, understand, and can control. And you can control where you direct your money with a self-directed account like a checkbook IRA or a solo 401k. And in that, two people are signing on the dotted line and often. So if you put your money in the S&P 500, yeah, sure, you can look back on the last since its inception, 50 years, 100 years, whatever it is, and you can get an idea of what the future looks like. Of course, that's no guarantee, but nobody's signing on the dotted line for what the performance is going to be of that fund, right? If I do a loan from my checkbook IRA to a borrower who wants to use that money for a fix and flip, we are putting the terms and conditions of the loan in writing, and we're both signing on the dotted line. Also, I understand real estate. I know how to evaluate a property. I know how to make sure that the borrower is sound and that there's enough equity and what they're calculating the ARV, the after repair value, to be. And I know enough about it to say, okay, this is a good deal or it's not, and what the numbers look like. You just can't do that without self-directing. So that's just one example. Multifamily real estate is another great example of self-directing, which our guest here today is going to talk about. And so I'm going to get out of the way and actually introduce her because I've talked already too much and we want to hear from Linda. Linda is a multifamily investor, property management expert, and co-founder of a real estate investment company focused on helping busy professionals build generational wealth through smart passive investments. Originally from France, she moved to the US with 2 suitcases and a dream back in 2012, transforming her background in sales and property management into a thriving real estate career. Now based in Houston, Texas, she leverages over a decade of industry experience to educate and inspire others to start securing their financial future through her popular networking calls, her social media content, and her appearances on several podcasts in 2024 and 2025. Without further ado, Linda, thank you so much for being here. I'm going to stop my screen share and you can share yours.
Well, thank you. Thank you so much for having me on. I do want to say it is a pleasure to be here. It's my honor to present. There's so much. I love what you just talked about, but you always want to make sure that you invest in something that you understand. And that's actually something that we always tell our investors. And I'm living, breathing of that. There's a lot of things that I don't invest in because at some point I will need to self-educate. But until I do, I'm going to stick to my lane and to what I actually enjoy reading and learning about. So I definitely echo what you talked about. And for that reason, thank you for giving me the opportunity again to present what I love to do. So, and thank you, Leah, as well for being on. Thank you to everyone who's watching. I definitely know how busy everybody is. So it's my pleasure to be on. I want to try to be brief, which means I'm going to go super deep into everything multifamily because there's a lot that we can talk about. But definitely, if anybody has any questions, I would love to talk more about the questions. So I do have 2 quick slides very quickly to present who I am, why you should listen, I guess, to my rambling. So as Brett mentioned, I am originally from France. I've been in the US for a little bit over 10 years now. You can actually see the top left corner. This was me at 21 years old when I moved. And right under it was my first property was a triplex in Chicago. So as you can imagine, a lot happened between that first property we bought in 2020 with my husband. So in the years it took, in the meantime, a lot happened, and we eventually took that knowledge and decided to get into multifamily. So that's what I will talk about today. But I like to show the original original properties that we started with. So as Brett mentioned, the company is called M2R. It stands for Married to Real Estate. Why? Because it's me and my husband, who you see here on the screen. His name is Connor. We actually met through mutual connections in real estate, which is another reason why we decided to call the company that. Because real estate, I always joke, has always been kind of like the third wheel between us. He's worked in property management. I have 10 years experience in property management. My mother-in-law, sister-in-law are in property management. We've won an award doing it. So that's definitely the family jam. Together, we have a lot of experience managing other people's properties, and then eventually we started doing our own. So like I showed in the previous slide, we started with the triplex, but pretty early on, we decided that we wanted to scale. And as you can see at the bottom of this slide, we have been co-GPs, which I'll explain just a second, on 3 opportunities so far. So those are the ones that you see at the bottom, and hopefully that's enough about me to explain why you should listen today. Thank you, Brady, by the way. I see in the chat. So thank you for the support. So let's talk about multifamily and why we love it. How does it work? Number one, what is it? What is a multifamily syndication? Syndication in general, whether it's multifamily or not, but specifically in multifamily is a real estate investment strategy where multiple investors kind of pull their resources together in order to buy a bigger asset that they could buy on their own. So it's not just money, it's also experience, it's also network, having access to the right lenders, having access to the right partners to make an acquisition come true. Everybody brings that together, whether you're an active investor or a passive investor, which again, I'll talk about in just a second. And thanks to doing that, we're able to close on much, much larger assets than just that triplex that we started with. Which is already pretty big, trust me. When it's your first one, it's definitely interesting. But like I mentioned, there are 2 roles or 2 ways that you can get started in multifamily. I want to try to touch on both today, and that's why it might become a lot. So again, I definitely invite questions. But essentially, you can be a general partner, which is what we've done 3 times so far. And the general partners, also called GPs for short, are basically the operators. They're in charge of finding the property, acquiring it, going through the entire closing process to buy it, managing it during the hold, and then eventually selling the property. Again, going through the entire closing process, but on the other side. If you are a limited partner, an LP, you're more a passive investor, and typically you don't really have to do anything in the deal other than pull in some capital. But I always tell people it's not so much passive investing, it's more so residual income, if anything, because even limited partners, as we were just talking about, have to self-educate, have to make sure that they know what they're getting into, and have to make sure that they understand all the risks and all the rewards before actually getting on a deal. And of course, you have to make sure that you know, like, and trust who you're investing with. Typically, if you're a passive investor, like I mentioned, you don't have a lot of day-to-day control, which is one of the biggest difference with being a landlord, is that you're not the one who's going to get the calls in the middle of the night. You're not the one who's going to have to make sure the occupancy stays high or looking at the project, overseeing all the capital projects, if there's renovations on the property and all that. But you do want to make sure that the people who do that and the people who are in charge, whether it is the property management team who is on the ground at the property day to day, or the general partners who are overseeing the property manager, whichever side we're talking about, as an LP, you want to make sure that they know what they're talking about. You want to make sure that they have the experience. You want to make sure that what vision they have for the property matches yours as an investor. And so that's really essentially the work that a passive investor has to do in a multifamily, is make sure that they understand the whole picture and are okay with it. And as general partners, like I mentioned, you go through the entire process that you see here on the slide. So you're the one who finds the deal, you're the one who underwrites it, meaning you're the one who has to look at the numbers before, like making sure the numbers make sense before buying the property. If the numbers make sense, you have to go through due diligence. So you have to physically go to the property, make sure that it all checks out, that there's nothing wrong with it. Maybe it has like a faulty plumbing system or a bad roof. Typically, you find all of that out during the due diligence. And if there's no issue and if the numbers make sense, then you acquire the property. And most people, they think that this is the end. I think this is the best part, the acquisition. I mean, it is. And that's why I put the little confetti here on the slide. But that's actually when the real work starts. And for us, because of our property management background, we understand that really the biggest part of a deal is the asset management. That's why I try to have that as being the longest on the slide, because that's when you actually have to deliver on everything that you promised the investors, the business plan that you agreed to with the team, and then, of course, delivering better housing for the residents. And so that's really what takes the longest. And then at the end, when it's all said and done, you either sell or you refinance your investors out and keep the property and you move on to the next one. So, of course, it's a very simplified way to look at it, but that's how I would say probably 95% of multifamily deals work out there. I do see, I hope it's okay to answer questions. I do see a question in the chat. Brett, totally up to you.
Yeah, go ahead if you want to answer it now. That's fine.
All right, great. So the question is, how do you decide to be a GP or LP when you're starting out? And is there higher risk as an LP since there is less on-hand work? So how do you decide, when you get started? For me, I always tell people it really depends on you. It really depends on how much time do you have, how much money do you have, and how interested you are. Again, I would never advocate investing in something that is going to be boring because that's not the goal, right? And I'm also always of the school that don't invest into passive income if it's going to become a second job, because in my opinion, it completely defeats the purpose. Unless you want to do that, at that point, you probably want to be a GP. And I'm not saying that being a GP is a second job, but you are going to be on the side of things that is actually monitoring, finding, looking after the deal for the entire time. And most deals last from 3 to 5 years, sometimes longer, sometimes up to 7. I've seen deals be 10 years long. So that's why I say it depends on the money and time that you have, because if you have more time, then you probably want to be a GP. If you have more money, you probably want to be an LP where you can put your funds into a deal and not be the person who's in control day to day. Now, is there higher risks of being an LP? That goes back to really your personality. Me personally, because I'm a property manager by day and I already deal with those calls in my day job, I don't want to do it in my personal life. We did start, me and my husband, as landlords. So I have seen that side. And I have decided that for my personality, for the amount of time that I want to dedicate to it, I would prefer to long run be more on the LP side, but there are people who prefer the control. There are people who prefer to be on GP, and there are people who prefer to own the entire piece by themselves and just be the landlord of a smaller property. So in terms of the risk, I would say it definitely goes back to your personality and are you going to be okay giving the reins out to someone else, basically. And then if we're talking about legal risks, I will say there's probably not enough time today, and I'm not an attorney. Feel free to connect with me afterwards, but the best answer is connect with your professionals, ask your legal pros, your tax pros about all the implications. Don't take my word for it. But that being said, why would you actually invest in a multifamily? Just like with any real estate, there's 3 ways that you make money or save money. The main difference is in multifamily, you buy larger deals. So of course, instead of having 1 unit, 2 units, 3 units, you have 50, 100, 150. So now you can multiply the cash flow by that much. You can multiply the appreciation by that much, and you can multiply the tax savings by that much, because those are really the 3 benefits. Of course, tax savings is a bit more passive. Like it's not money that you make, but it's money that you're going to save. And a lot of times that's why high income earners love multifamily, because typically the more money you make, the more taxes you pay, right? That's usually how it works. And typically the more money you make, the busier you are. So multifamily could be this great way of investing your money, making sure it works for yourself, twice. First you earn it at work and then you put it to work in a deal. but you don't have to spend the time and you're already getting the tax savings like from day one. And that in a way saves you money down the line. Then there's cash flow, which is also always nice. So one thing that I didn't mention earlier is when there's a multifamily deal on the table, GP and LPs split all the benefits. Usually, again, probably I would say 60-70% of deals, it's a 70-30 split. That means LP bring the money, LPs bring most of the money, and they will get 70% of the cash flow and appreciation. The GPs will split the remaining 30%. And if you are a GP, you can be GP and LP at the same time on the same deal, by the way. So the cash flow will go to LPs first. Sometimes there is something called a pref. And I don't want to go into all the details, but that means that LPs always get paid first. They're always the most important when it comes time to share the profits. And then after the pref, you go that split of 70-30, 80-20, 60-40, whatever it's agreed upon. And whatever the extra is goes to the GPs last. Same thing for appreciation. When it's time to sell or refinance the property, typically that's the biggest payout. That's when most money is shared amongst the entire team. And again, it will be shared based on the split that was agreed upon at the time of closing the deal. 40, 70, 30, 80, 20. Cora has a question. How will it work if we're GP and LP at the same time? So I don't want to go into too much details, but when you get on a deal, you will sign what's called a PPM, a private placement memorandum. The private placement memorandum will explain like the percentage of ownership, like the shares that you have in the deal. So if you're an LP, you'll have a share for that. And then if you're a GP, you'll have a share for that. Hopefully that answers the question. And hopefully I answered Jonah's question as well. He said, thank you. So I hope so. All right. So like I mentioned, I do want to, like this presentation is kind of meant for both, whether you GP or LP. So here on the screen, like a lot of everything that I'm talking about applies to both, but your involvement will depend on which side you're on. So I did want to talk about, we want those benefits. We want to have the tax savings. We want to have the cash flow. We want to have the appreciation, but not every deal gives that. So how do we spot a good deal? And what I wanted to talk about next. There's 7 green flags that we look for in our team. Number 1, an experienced team. Again, this is 100% team sports. You cannot, I've seen it, but it's rare to run into somebody who owns 20, 30, $40 million properties all by themselves. Typically, most of the time, it's going to be an entire team, either openly or behind the scenes. And you want to make sure that when you are getting on a team, you understand exactly what are your strengths, what are your weaknesses, and make sure that the team, like if you have weaknesses, your team members have those as strengths. So let's say, for example, you're completely bad with marketing. You're probably not going to be the one who prepares the monthly updates to the investors. So you want to have somebody who will do that, who will have a better eye for design. That person might also be in charge of renovations while we're at it. Because if you're completely bad with colors, that would be better. The most important thing when it comes to team is that first word, experience. You'd never want to be the guinea pig of a brand new team that has no clue what they're doing and this is their first deal. And when I say never, of course, you never want to say never. Don't take anything I say as advice, but you want to make sure that you go with strong operators. It's real estate. At the end of the day, things will go wrong one way or the other eventually. It's okay to say it because it's just the reality. So you want to make sure that you go with teams who know what they're doing, who have gone through multiple cycles and have been able to weather multiple problems in multiple markets, as much as possible at least. Once you have a good team, you want to be in a great market. It's amazing to have a nice property, but at the end of the day, if it's on the street where nobody ever goes or nobody ever wants to go, you're probably not going to grow much. Your property probably is not going to attract the most renters. And even if it does, it may not be the best renters. So you want to make sure that you are in a market that is good, that has low crime, for example, that is growing, where people are actually moving to, where there's job opportunities. You want to make sure that there's going to be long-term demand for housing. That's really the main thing is making sure that more families are moving, more people are moving, and also not just rely on one type of demographic. So, for example, it's great to be next to, let's say, a hospital or an Amazon warehouse, but make sure that you have renters who do other things, because if that hospital shuts down or that warehouse shuts down, for example, you don't want to lose all of your renter pool out of nowhere just because you were relying on one industry. So those are all the things that we look at when we look at a market. Essentially, it's recapped by saying we're looking for the path of progress. So we're looking for neighborhoods that may not already be the best, but they're on their way there. They're growing, they're getting bigger, more people are moving there, and they're going to attract a lot of population in the foreseeable years. Then we get a little bit more into the weeds of the deal itself. Of course, you want to have positive cash flow, especially in a syndication where you're going to have to share that cash flow with the investors. If you want to attract the right investors and the right team members to operate the deal, there has to be enough meat on the bone for everybody to share. So when you look at all the rents and all the income, whether it's late fees, pet fees, move fees, amenity fees, whatever it is, once you take all of that and you remove all the expenses, property management fees, taxes, insurance, repairs and maintenance, turnovers for whenever people move out, you have to redo their units. Once you do income minus expenses, that's your profit. And if there's no profit, you don't buy the property. Now, we focus on, I'm going to jump real quick to value add potential because that's very important. We focus on properties where the profit may be lower right now, but there will be ways to increase it. For example, maybe all the units are a little bit older and we're going to renovate them. Maybe there's a giant empty lot in the back that we're going to turn into a great dog park or a parking lot, or we're going to add some storage units. Maybe sometimes it happens, unfortunately, there's bad property management and they're really spending too much money. The expenses are too high. And there's a lot of ways that you can save money by lowering those expenses. And in that case, it increases the profit. Whatever it is, whether it's operational or physical, we look for those value add opportunities because we want to make sure that it profits today, but how can we make it profit even more tomorrow? As I mentioned earlier, those deals are usually 3 to 5 years or longer. So you want to make sure that it's going to grow with the market and that you're going to be able to force appreciation through those value add opportunities. And then going right back to location, right? If you're going to be in the path of progress in terms of market, you might as well be next to a great school, or you might as well be next to public transportation or next to a major company that's always hiring. Because you could say Houston is a great market, but there's a million submarkets within Houston. And that's why location will never fail us as real estate investors, because as long as you're in the right spot, somebody will eventually want to buy from you and somebody will eventually want to rent from you while you're holding the property. And yes, Brady's saying the underwriting is essential to check the value of the property and to analyze risks with the property. Absolutely. And that's why I had on the slides earlier, first you do the underwriting and then you do the due diligence, because it's super important to look at the numbers, but then also make sure that the reality matches those numbers. I mean, I don't want to be negative, but sometimes there are people who hide things and you want to make sure that you know what you're buying. As important as the numbers are to review on paper, you want to make sure that they also check out with what's physically there. And that's why underwriting is so important, not just to go through the process, but also to understand what you're underwriting, understand the numbers. That's it goes actually into the next green flag, which is solid financials. So when you look at multifamily, there's 2 reports that you start with. Like, let's say somebody sends me a deal tomorrow, more than likely they're going to send me the T12, which is short for trailing 12, and the rent roll. The trailing 12 shows all the income and expenses for the last 12 months, which means if it's a T6, it's 6 months. If it's a T3, it's 3 months. And it shows me all the money that came in, all the money that went out. And then the rent roll shows me, and it should match, right? The rent roll shows me who lives there. When did they move in? When is their lease supposed to expire? Is there any deposit that they put down? How much is their rent? But also, if the rent roll is like a very good one, it will also show me all the other charges that they have. So, for example, if I see a pet fee, when I go do my due diligence, I will make sure that there is actually a pet. Or if I don't see a pet fee, I will make sure that there's no pet. So this all goes into the underwriting of making sure, yes, do all these numbers check out? Not just in terms of, is it going to make money? But also in terms of like general rules. For example, let's say you are buying 100 units. Well, in Texas, the insurance is probably not going to be the same as if you were buying 20 units in the Midwest. And so that's why it's another reason to have a very good understanding of underwriting and markets, because the person who is the underwriter on your team, again, going back to the experienced team, right? Surround yourself with people who know what they're doing. The person who is the underwriter on your team needs to eventually know, okay, here, this is a green flag. Here, this is a red flag. Nobody would ever pay that much for repairs and maintenance, for example. Or how come they're only paying that much for property managers? Or I know for a fact that you're going to have to pay attention to taxes in that market because they change every year or they change every other year. All of those go back to how important the underwriting is. And then again, the due diligence, because there's no such thing as napkin underwriting, but you cannot spend hours on every single deal that comes across your way. So you always want to start with a little bit and then go into, okay, now let's get quotes from service providers. Now let's actually verify all the information that was given to us. Let's call the county and check out the taxes. All of those things are important parts of the underwriting. And again, it goes back to Jonah's question earlier. That's the role of a GP. Within the team, within the GPs, there are multiple roles that you can assume, and underwriting is a big one for that reason, because they are the person who's going to look at the property today and make up a business plan and decide how realistic it is to actually stick to this business plan. And typically you want that person to work along your asset manager, because your asset manager will be the one to execute the business plan. They will be the one to strategize with the on-the-ground team, the property management team who's there every day, to make sure that, hey, if we on the road that rents are going to increase by $50 next year on average, then the asset management team is supposed to make sure that actually happens. And constantly go back and forth with the underwriter throughout the entire deal to make sure that we're on track with what we promised the investors. So that's all the work that I was talking about. If you want to be on the GP side, you have to have the time and understand everything that you're signing up for. The last thing is condition of the asset, which again goes back to the due diligence. Is the property looking good on picture, or is it actually good when you go touch it, when you have engineers come, when you have architects come, when you have your property management company bring a contractor to analyze, okay, did we budget enough reserves so that, God forbid something happens, we will have money set aside to address it. All of those things are things that you want to make sure you find out early, because let's say the seller has done a lot of deferred maintenance and has not addressed things. Now when you buy the property, it's going to be on you to do those things. Let's say there's a lot of work orders about the AC system. Well, you're not going to let your renters not have AC once you buy and once you operate the property. So that's what we mean by condition of the asset is it in good enough condition that you want to buy it? Or if it's not, which is okay at times, if that's what you want to get into, but what is your plan and are you ready to do what it takes to get it there for the betterment of the renters, but also for the investors' returns. So I know I talked all about underwriting, and I've said a lot already. So if there's any questions, please put them in the chat. Happy to answer those. But there was a couple of things that I wanted to talk about when it comes to underwriting basics that I think are important to know for everyone, whether you're GP or LP, at least to understand what those terms mean. So number one is the net operating income. It's the profit. It's the income versus the expenses. Now, something that's important to note is income versus expenses before the debt. Not going to go into too much details, but just remember that. Just remember that it's not including your own. And then the cap rate is short for, I believe, capitalization rate is the NOI divided by the purchase price. So Cora has a question that's meant for Brett, because I don't know. She's asking if it will be recorded. But yeah, the cap rate will kind of show you, that's a very quick way of comparing properties. So let's say a property has an NOI, a net operating income. So after income and expenses, it makes $500 a year, and the cap rate is 6%. Then your property is worth $8.3 million. And it's an easy way to compare it to other properties in the same area that should have the same cap rate. It's really a market indicator, so that means it's not a perfect indicator, but it's a good place to start. The cash on cash return, that's the annual cash flow divided by your initial investment. So let's say you put in $100,000 in this property and it gives you back $10,000 that year, then your cash on cash is 10%. Ideally, a property, everybody's criteria are different, right? But ideally, we look for properties that will give at least a cash on cash of 8 to 9%. If it's lower than that, we'll take another look as to why we want to do that. But if it's 8 to 9%, we'll start going further in the underwriting. And then the IRR, the internal rate of return, that's really like, again, something for both parties to be aware of, but especially LPs, because it measures the total return of your investment over time. So once you put in all the cash flow, all the appreciation, and how long it took you to make that money based on your initial investment, that will give you the IRR. It's quite a complicated formula, so that's why I didn't put it on there. But yeah, just know that this is what it stands for. And the easiest way to think about it is the time value of your money. So of course, the longer you hold on to an asset, the lower it goes, because what you want is to be able to recycle your money quickly. So hopefully we're doing good on time. I only have 2 more slides, so I'll try to be quick. I did want to share in practice what that looks like. I love webinars and podcasts, but I always like to see real life examples. So on this screen here, I put myself in my LP shoes, and I compared our first triplex numbers compared to our first investment as a limited partner. So the property on my right, so it would be the left on the screen, I believe, it's our property in Tulsa, Oklahoma. And as you can see, the responsibilities on that one were limited partners, me and my husband. So what we had to do was vet the team, vet the deal. And then because we knew that we wanted to become GPs, we also attend weekly calls. Normally, LPs don't really do that. That's just something that we like to do. Typically, LPs will more so attend a quarterly webinar that just kind of tells them, hey, this is what's going on. And then once a year, when you're an investor, you will be given a K-1 for your taxes, and you'll pass that on to your accountant. And that's it. Those are the responsibilities as an LP.
It's on our right also, just so you know.
I'm sorry?
It's on the right.
Good.
Same side.
So no, I do promise that I'm a good driver. Whereas when we had the triplex, you see the responsibilities above, we were responsible for everything. So we had to find our tenants, we had to deal with the vacancies. And by the way, we closed on that property in January 2020. So as you can imagine, we had quite a lot of fun with the vacancies, but also just in general. So we managed the repairs, we managed the initial renovations. You have to pay all the expenses. It wasn't at this property, but one time we had an AC that stopped working in the middle of May in Texas. So when that happened, if you're the landlord, you have to replace the AC. You don't have a choice. You're not going to tell your tenants, hey, no AC this summer. That's not a thing. I see Brett shaking his head. He's like, no, you're not going to do that. So you have to handle collections when you're the landlords. If somebody's not paying, you have to have systems to go collect that money, whether it's you personally with big muscle guy or whether you have other ways of doing it. You're in charge of all the maintenance calls, all that kind of thing. So again, going back to Jonah's questions earlier, those are the kind of things that you have to decide if you want to be an LP in terms of the risks. It's like, okay, I will not have access to the day-to-day control of the property, but also this is what I would do if I was the landlord and owned the whole property by myself. And then I put in the numbers. I'm not going to go over the numbers because we'll be here all day, but just know that those are real numbers that we have painfully tracked on Excel over our years as investors. I didn't put our properties here as GPs, but always happy to talk about those too. And again, what those responsibilities versus the numbers are on what we've done so far. So now it's your turn. That's kind of like the end of my presentation. These are the 3 steps that we believe you should start with if you want to be a GP. First of all, you have to find that amazing team that we talked about earlier. You want to make sure that they are as experienced as possible. And you want to make sure that you also bring your best self and your best qualities to the table to actually enhance the team, right? Once you have that team, you'll find the perfect deal. And it's hopefully going to be awesome in the best market ever and the best opportunity financially. And once you do have those too, then you'll have to raise capital. And the reason why I underline legally here is because I didn't want to go into all the details of 506B versus 506C and accredited versus non-accredited and how you can invest. Because by the way, as Brett mentioned, there's a multitude of ways that you could become an LP. You don't just need cash. Spoiler alert, our first property, we actually invested out of a life insurance policy. So, but all of those little nuances and rules, just know that there's very clear laws about it. I don't know about you guys who are watching, but I don't think Brett would look good in an orange jumpsuit. I wouldn't look good on an orange jumpsuit. So that's why I underline legally, because just know that. Just know that if you want to be a general partner, at some point you will need to raise money, and you have to make sure that together, not just you, but as a team, you want to make sure that you do that within the rules and you're taking care of your investors the right way. And if you'd rather be an LP, like we have been in the past, then we're happy to talk about that too. And like I mentioned earlier, the responsibilities in that case are a lot more upfront. And then once you place your funds, that's it. You're done. So I hope I did okay on the time. And if there's any questions, happy to go
Yeah, you
over
did
them.
great. You did great. I want to make a couple comments if that's okay.
Absolutely.
So yeah, you can use your personal funds, you can use retirement funds if you set up a self-directed account, you can use life insurance policy
Sorry.
and you take advantage of, like the, what do they call it? Infinite banking type of thing. Super cool strategies out there. But what I wanted to just make a comment on was you can be a real estate investor in a multitude of ways, right? And by the way, my idea of being an investor is long-term. Flipping houses is not a real estate investor, okay? That's a job. It's not, people call it real estate investing, but it's not real estate investing, in my opinion. You still have to find the good deals. So that part of it might be the same. But after acquisition and even crunching numbers, ARV versus repairs and everything looks a little different when you're flipping than when you're going to buy and hold, whether it's multifamily or single family or whatever. There's the few ways I want to focus on real quick is you can be a single family home long-term real estate investor, buy and hold rental. Okay. When you do that, you can have a property manager, of course. And by the way, when you're crunching the numbers, whether you intend to do your own property management or not, you should always include 10% for a property management fee because you might one day not want to be the property manager. And if you didn't figure that into the cost of holding, then the numbers might not play out. You may all of a sudden be negative. So factor that in. Aside from that, you're in charge of the tenants, the toilets, and everything in between, okay, when you own a single family home. Property manager can be in the middle of that. When it comes to multifamily, you can be the general partner, yes, which is more like being that landlord on a single family home that I was talking about, where you're kind of responsible for everything. But in both cases, you get the advantages of whatever cash flow there is, appreciation, depreciation, which is part of the magic of real estate that hopefully we didn't even talk about depreciation. That's kind of a whole nother concept, but I'll briefly give an explanation of it in a moment. Single family home rental, real estate investor gets all that. GP, real estate investor for multifamily, gets all of that. LP, multifamily real estate investor, gets all of that. Okay. So if you want to be as passive as possible with this, but still get pretty much all the advantages of owning real estate, being an LP in a multifamily syndication is probably the way to go. Now, of course, it's up to you, but people that invest in multifamily syndications are oftentimes high-income W-2 earners, doctors, attorneys, dentists, whatever. They don't have time to be a GP, okay? And they also don't have time to go out and look for a single-family home to buy and rent. They just don't have time for that. Although they have more time for that than being the GP on a multifamily, that is for darn sure. But an LP is more passive than the first two. So I just wanted to throw that out there. If you want passive and you want all the advantages of everything that comes along with owning real estate, then be an LP. You can do private lending. Like a lot of our clients do private lending on real estate. That's a passive activity and you get the returns from the loan being paid back. What you don't get is the ownership benefits of the real estate. So it's similar, but different. An LP is more like being a private lender, but with the advantages of owning real estate. So when you get to report all those losses, especially in the form of depreciation, and we didn't talk about cost segregation, which I'll probably let you do for a minute here because that's a key factor in owning multifamily real estate. But with the depreciation, you essentially get to report those losses against your earned income and reduce your tax liability by that much. Now, there's a difference between how much you can do and what the max is. There's some recent law changes on that, which I'm not totally up to speed on. But then you can claim real estate professional, which is a whole nother conversation. But at the end of the day, you can report those losses against your W-2. So let me give a quick example and then I'll shut up, Linda, and let you talk. When I first started buying single family homes across the country, I never did multifamily, by the way. They were just all single family homes. And I did not own these in a retirement account. It was just my personal money. I had a W-2 job. I was making good money, but I was able to report enough losses because I figured out a way to have some bonus depreciation that kind of went above and beyond the $25,000 that you normally were capped at back then. But I was able to report enough losses to where my I paid zero taxes on my W-2 income. And I was making this is back in like 2008, 9, 10. So I was making like 120 a year at my W-2 job, which was pretty good for me back then. And I paid zero taxes on that because of the rental real estate I had, because of the losses. Now, that wasn't necessarily a good thing because there was some negatives on my cash flow each month, which is a whole nother conversation. But most of that was the depreciation. Okay. Being a limited partner in multifamily syndication can do a similar thing for you, depending on how the numbers play out, but especially with cost segregation, which I'll let Linda kind of touch on a little bit because I think that's important.
Yes, you're 100% right. And I have met many, many people who, like you, Brett, don't pay taxes, or at least not as much as they would if they were not owners. One thing that we always say is, at least in America, the tax code was written for property owners. And when you do debt deals or flipping or maybe even wholesaling, you don't have ownership. And so that's the difference. I mean, if you flip, you have ownership while you're holding it, right? But typically it's not very long. And so that's the beauty of an LP is, like Brett mentioned, my presentation was from 2 suitcases to 397 units. I don't own all 397 units, but on paper I do. And so when it comes to tax depreciation, I do too. And that's the beauty of it. And that's why it's so great to own real estate. And if you do it as an LP, then you don't even have to have all the day-to-day responsibilities. Now, again, in a syndication, not everybody owns 100%. So you have to ask yourself, would you rather have 100% of a grape or 10% of a watermelon, right? Like everyone always says. But cost segregation in a nutshell is you bring on an engineer, like an actual expert who goes through the entire property one by one, every component, every appliance, every feet of fencing and what's in the management office, and they count everything. And normally for a residential property, I believe, if I remember correctly, it's 27 and a half years that you can depreciate an asset. So meaning the IRS understands that, hey, you're making money on a property, but at the end of the day, it's also deteriorating, right? So they will give you 27 years worth of depreciation. Normally, if you just take it as it is, and every year for 27 years, you depreciate a little bit. If it's commercial, it goes up to 39 years. But if you do a cost segregation, because you're breaking the property down to its components, because you're saying, like, I don't know, we have 100 fridges and we have that much roof surface or whatnot, then all of those different components are depreciated differently. Obviously, it takes a lot longer for a roof to deteriorate as opposed to a stove, especially when the stove, like maybe that unit gets re-rented to new people every single year, it gets a lot more usage. So that's why you may want to depreciate that one over 5 years, whereas the roof is 20. And I'm just throwing numbers at that point. I mean, the 27 and 39, I'm pretty sure are accurate. But
yeah, you're right.
But in terms of like the roof and the appliance, that's why you use an expert. That's why you use an actual cost segregation engineer who will come to you because they understand the laws around the IRS, and they have like the whole table that tells them, hey, this is how much for this, this is how much for this is how long, sorry, for this and how long for that. And so at the end, they give you this beautiful report, which is called the cost segregation study. And by giving that to the accountant and the tax person, then they're able to provide K1s to the entire teams that show, okay, this is actually how much depreciation we had this year based on essentially where we are in the useful life of the property as a whole. And then every investor gives the K1 to their own accountant, and based on their situation, their own accountant is able to say how much taxes they're going to pay. And going back to what Brett was saying, this is why a lot of high income earners, and that's not like I'm, explaining how it works for a lot of people, but a lot of high income earners, they love to LP for the tax benefits, to the point of sometimes looking at their family unit and saying, hey, one spouse makes a lot more than the other. Maybe the other ought to go more of like a part-time position or no position at all and become a professional real estate person, because now you can start offsetting your active income and your W income to income like Brett was doing. And then at that point, the sky's the limit, right? Like we know a lot of people who make a quarter or $500,000, maybe sometimes a full $1 million a year. If you can offset a lot of that, and not pay it. That's why I put that as a benefit of multifamily, because even though it's not money that comes to you, it's money that you save, and sometimes it's just as important and just as powerful. And that's the
Yeah.
perfect part, the
Uh,
best part of the cost segregation. One thing that I'll finish with is that right now we have the 100% bonus depreciation, which allows you to depreciate 100% up front. And that's something that had come and gone and come back. We don't know for how long it's going to be on. Again, I'm not a tax professional, but definitely it's also an added bonus from that.
Yeah. And so just real quick, because we're coming to an end here, with a single family home, and really the same for any real estate, when it comes to what depreciation is, it's basically the improvement, right? It's the property, the physical structure minus the value of the land. Okay, that's the simple way to do it. What most real estate investors do with single family homes is they look at the purchase price and they say, okay, I bought this house for $100,000. The land is worth 20, the property's worth 80. Divided by 27 and a half. That's what's called straight line depreciation. So you literally just take 80,000 divided by 27 and a half years, and whatever that number is, $5,000-6,000, whatever, per year is what you get to report in losses against your earned income. Okay, so that's how straight line depreciation works. When it comes to cost segregation, the cost seg study allows you to actually not only detail out, and you could do this with single family homes as well, by the way. It's not maybe as effective as multifamily, but it's the same principle. The drapes,
right, as long
the
as
curtains,
it's an investment one.
As long as it's an investment, not
and I will say
owner-occupied.
I have done it myself on a single family home. So yeah, great point.
Perfect. But the the windows, the value, the carpet, the walls, everything is part of this study. And instead of 27 and a half years, you actually take a much larger dollar amount. It wouldn't be 80 in this case. It would be a lot more because they break everything down. And like Linda was saying, it's all calculated a little differently. But instead of 27 and a half, they slam it all into 1 to 2 years, give or take. And that's why you can report so many losses in such a short amount of time with doing the cost seg. So wanted to make sure we studied that or talked about that. Doesn't apply as much in the retirement account because there is no taxes in the retirement account. So there's really no losses to report, with some exceptions for an IRA that we definitely don't have time to get into on this call. But Linda, thank you so much. We really appreciate this. It was amazing. I enjoyed it. I hope everybody else did as well.
Yes, thank you so much for having me on. It was great to talk about it. I'm not used to going that deep into a full presentation. And again, like you mentioned, there's so much more that we could talk about, but it was awesome. So thank you.
Did you share a way to get a hold of you if people want to talk to you? I don't know if you
sure.
showed that.
Let me I think I had my blank on the last slide, but let me put it in the chat. I'm happy to share it with your team as well if there's a way to put it afterwards. But essentially the easiest way is marriedtorealestate.com. So it's married2realestate.com, or I'm most active on LinkedIn. So if you're watching us live on LinkedIn, find me there, Linda Holtz.
All right. Thanks, everybody. Thanks, Linda. Have a great rest of your day.
Thank you so much, everyone.